Look, okay, here's what happened. Stephen Lynch asked why, when the Trump administration took office, more than 100 enforcement actions were suddenly dropped. Cases involving banks, consumer protection, and crypto companies. Cases worth over $3 billion in penalties. Now think about that. That kind of question deserves a clear answer, especially when it's being asked to the Secretary of the Treasury. But that's not what happened. Instead of answering, the question was brushed aside. The response went in circles. And then something was said that really matters. It was said that if AI denies someone credit, explaining why is not viewed as a priority for financial stability. Think about that. If an algorithm locks you out of a loan, if a system discriminates against you, being told why is not considered important. So, yeah, this wasn't just uncomfortable, it was revealing. All right, watch this. Then we'll explain what it actually means for consumers, oversight, and your money.
When the Trump administration came into office, they immediately took steps to either halt, dismiss, or roll back over 100 enforcement actions and investigations against corporations in its first 2 months in office, with a very heavy concentration on financial services, consumer protection, and cryptocurrency, totaling over $3.1 billion in potential penalties avoided. Now, as a member of the Financial Services Oversight Council, is that a concern that you have raised within the council, all these immediate dismissals of cases against financial services firms?
Well, I think the Biden administration had an extinction.
Sir, please be responsive to my question.
I am trying, sir, and this back and forth is just eating your time, that the Biden administration had an extinction policy for crypto
This
assets.
is when Trump came into office. I'm going to go to the next question because your answers on, Mr. Chairman, the answers have to be responsive if we're going to have a serious hearing here.
Well, the questions have to be serious.
Well, those are 100 dismissals of cases that the Trump administration came in and executed in their first weeks in office, like that. All of a sudden, all these crypto cases went away. The SEC was dropping cases. The Consumer Financial Protection Bureau dropping cases. And well, sir, look, you're on FSOC with all the heads of these agencies. This should be a serious question to you. Trust should be a serious question and a serious issue for the financial services industry, especially as the Secretary of the Treasury. Well, that's an important. No, this is my time. I haven't asked you any more questions. I haven't asked you any more questions,
It's the gentleman from Massachusetts.
I'm trying to get to my next question.
Could you speak a little louder? I can't hear you.
Yeah, okay. I might.
Mr. Secretary, let Mr. Lynch proceed with his time. Put 4 seconds back on the clock, please.
Thank you, Mr. Chairman.
Yes, Mr. Lynch.
I just want to do a comparison of the FSOC reports. Let's go back to 2024, and then we'll talk about the current report. In the previous report, the members of FSOC expressed serious concerns related to potential risk to financial stability regarding the lack of explainability and high complexity of AI and the approaches that have a potential to heighten financial instability, especially in the areas of bias and discrimination in credit decisions. That was in 2024. Your report in 2025 focuses on removing regulatory impediments. So in 2024, we were concerned about consumer protections, and now, under your leadership, we're concerned with eliminating regulatory impediments. The dangers, and that was a report during a time where the chairman and I were co-chairs of an AI task force. Those dangers haven't gone away in reality. Those dangers are still as severe for the American consumer, but they are absent from FSOC's report. So it's obviously you've eliminated or dropped that priority as an issue for FSOC. So can you explain the change from protecting the consumer and now eliminating regulations?
We are charged with financial stability, and we are focused on leveraging AI strength in the financial system resilience, but with economic growth and a security lens.
On the issue of explainability, any concern about that in the use of AI in the financial services industry?
I'm sorry, what was the question?
The issue of explainability, how when people apply for credit and are denied, we don't have the ability for AI to explain why they were denied. Is that a concern? I mean, we are talking about the trust within the financial services industry.
It could be a concern, but we don't view it as a priority for financial stability.
That's the truth. That's the truth. Okay, Mr. Chairman, I'll yield back.
All right. Now that you've seen the exchange, let's slow this down and look at what actually happened, because the details here matter. Stephen Lynch was not asking a vague or ideological question. He was pointing to documented data. Public Citizen, along with multiple news organizations, tracked federal enforcement actions after the Trump administration took office. In the first weeks alone, more than 100 enforcement actions and investigations against corporations were halted, dismissed, or rolled back. These were not random cases. They were heavily concentrated in financial services, consumer protection, and cryptocurrency. According to Public Citizen's corporate enforcement tracker, the potential penalties avoided totaled more than $3.1 billion. That number is not a talking point. It reflects the actual dollar value attached to cases that were already active. Evidence had been gathered, investigations were underway. When those cases were dismissed, the penalties did not get reduced. They disappeared. Now, here is why Lynch's question mattered. The Treasury Secretary sits on the Financial Stability Oversight Council, known as FSOC. That council includes the heads of all major financial regulators in the United States: Treasury, the SEC, the CFPB, banking regulators. Its purpose is to identify risks to the financial system and protect stability. So when Lynch asked whether it was a concern that so many enforcement cases were dropped at once, especially in finance, consumer protection, and crypto, he was asking whether anyone inside that council raised a warning, whether anyone said this could undermine trust, accountability, or long-term stability. That question never received a direct answer. Instead, the response shifted away. The discussion moved to the prior administration, then to crypto policy, then to innovation. None of that addressed the central issue. And when Lynch pressed again, the tone changed. The question itself was treated as unserious. That moment matters because it leads directly to what came next. Lynch then compared FSOC's own reports. In 2024, FSOC explicitly warned about risks related to artificial intelligence in financial services. The report raised concerns about lack of explainability, high complexity, and the potential for bias and discrimination in credit decisions. That language was not theoretical. It reflected growing concern that AI systems were increasingly making lending decisions without clear explanations, even to the institutions using them. In the 2025 report, that language is largely gone. The focus shifts toward reducing regulatory impediments and easing burdens. Concerns about AI explainability and discrimination are no longer emphasized. Lynch asked why. When asked directly whether explainability in AI credit decisions is a concern, the response was telling. The answer was not no. The answer was that it could be a concern, but it is not viewed as a priority for financial stability. That sentence is important. Under federal law, when a person is denied credit, lenders are required to provide a reason. This requirement comes from the Equal Credit Opportunity Act. The purpose is straightforward. People deserve to know why they were denied a loan, a credit card, or a mortgage. AI complicates this. Modern lending systems can analyze hundreds or thousands of variables. In many cases, even the lender cannot fully explain why a specific decision was made. That is why regulators had been working to ensure institutions remained compliant with the law, even when using complex algorithms. So when explainability is described as not a priority for financial stability, what that means in practice is this: the system can function smoothly for institutions even if individual consumers are denied credit without clear explanations. Stability in this framework is about the system, not the person. Now connect that back to enforcement. Many of the cases that were dropped involved the same sectors Lynch was asking about: crypto exchanges, consumer finance firms, financial institutions using advanced technology. The SEC dismissed or paused enforcement actions against major crypto platforms. Some were dismissed permanently, others were frozen indefinitely. The stated justification was regulatory discretion and reform. At the same time, the Consumer Financial Protection Bureau was effectively put on hold. In early 2025, leadership ordered a pause on enforcement, litigation, communications, and rulemaking unless explicitly approved. Attorneys were instructed to delay cases already in court. Rules that would have limited overdraft fees and removed medical debt from credit reports were suspended. These actions were documented by NPR, court filings, and internal communications reported by journalists. So when Lynch raised consumer protection concerns during this hearing, he was not speculating. He was questioning a pattern that was already underway. Enforcement reduced, oversight weakened, and official reports shifting language away from risks tied to AI discrimination and explainability. The response he received was not uncertainty, it was clarity. When asked whether transparency and consumer trust mattered, the answer made priorities clear. Those issues may exist, but they are not central when it comes to financial stability. That framing has consequences. If you apply for a mortgage and are denied, you may receive a vague explanation generated by an algorithm. If that explanation is insufficient, there may be fewer regulators actively enforcing the law. If patterns of discrimination emerge, oversight mechanisms are weaker than before. Historically, agencies like the CFPB were created because regulators failed to protect consumers leading up to the 2008 financial crisis. Since its creation, the CFPB has returned more than $20 billion to consumers through enforcement actions. Those actions resulted in real penalties and real restitution. Pulling back from that enforcement does not eliminate risk. It shifts it away from corporations and onto individuals. That is why this exchange matters. It was not just tense, it was not just procedural, it was a public statement of priorities. When enforcement cases are dropped, when reports change their focus, and when explainability is dismissed as secondary, it signals exactly what kind of system is being built. A system where institutional efficiency comes first, a system where accountability is optional, and a system where explaining why an algorithm denied you credit is not considered essential. So when you hear the phrase financial stability, pay attention to how it is being used. It is not about whether you can trust the system. It is about whether the system operates smoothly for those at the top. And when a congressman asks about that shift and is told his question is not serious, that response itself is the answer. At the end of all this, the takeaway is simple. If protections that took years to build can be paused, dismissed, or redefined as low priority, the burden does not disappear. It moves, and it moves directly onto consumers. That is the reality behind this hearing. If you found this breakdown helpful, support the channel by liking the video and subscribing. Share it with others who want clear, fact-based explanations of how these policies affect their money and their rights.